Good morning. I hope that you are surviving stage 6 load shedding. We're currently being load shed right now and surviving the market volatility. What a nightmarish month. Really is dark. They say it's darkest before dawn. I'm confident that the global markets will see a dawn sooner rather than later. It might be 6 months, it might be 18 months. We can debate that over the course of today, but we will see the dawn. I'm not as certain that Eskom will ever see a dawn. Any light we see is not a light at the end of the tunnel. It's probably just the smoldering ruins of the power stations. Anyway, I will rant more about that later on when we get to South Africa. Let's look at the June market review. Quite a phenomenal month. You can see their world equities down 4%. SA equities down 6%, and that was driven primarily by resources, which were down 17% for the month, and that was on the back of the commodity metals index being down 13%, the biggest slump in the metals index since 2008. So surely metals and even oil was down, but commodities are pricing in a recession. And world markets certainly are also lower than when we met last time. The good news is that our defensive positioning worked well during the month. Our three defensive positions, value, China, and healthcare, worked relatively well. Value not so much this month, but China up a whopping 14.2%, just fantastic. And we expect to see more continuation of that, people rotating out of the West and into China in particular. Healthcare also looking defensive, up 3% for the month. US cash, once again being very defensive and far more defensive than global bonds, and we can continue to avoid global bonds, which are only up 2% for the month. So that was the end of the first half of 2022. I'm sure when we were all wishing for 2020 to end, we didn't expect things to get this bad so soon. I certainly didn't. And what an incredibly bad first half it's been. Far worse than I was certainly expecting. In fact, it's the worst first half for the S&P 500 since 1962. So a 60-year low. It's quite incredible in terms of how bad 1H has been. And that does set the ground for things not looking as bad going forward when you are at a 60-year low. When we last spoke, it was that markets were down 20%, and we were saying that markets don't fall more than 20% out of a recession. Equity markets are now down further. S&P got to a low of 24% before it picked up a bit from its peak, and is certainly suggesting that we are going to see a shallow recession. But many other indicators are not confirming that. So, and we'll also talk about that right now. But looking at the 1H asset classes in review, you can see there are not many places to hide. Global equities down 19%, global bonds down 12%, gold up as much as SA cash and US cash. So whether you're in gold or cash, you had similar protection, a lot less volatility in cash. So I still prefer cash, dollar cash to gold as a place to hide. But what is nice, and although it's a bit of a silver lining, again, the three places that we've been hiding: value, healthcare, and China. You can see there that China only down 8.5%, healthcare down 9.5%, value down 11%, and our proxy for value, the UK, down 9%. So those three sectors or geographies or themes doing much better than world equities, which were down 19% in the first half. The one thing we did get wrong was SA equities, which are only down 5.5% for the first 6 months of the year, which is an incredible performance considering what's going on in South Africa with stage 6 load shedding and metal prices collapsing. But again, I'll talk more about that when we get to South Africa. And we continue to remain underweight South Africa on equities. Looking at June 2022, Sygnia funds in review, China #1 again, fantastic and an amazing return. The Sygnia China New Economy Global Equity Fund up 16.4% for the month, awesome. The Sygnia Itrix New China Sectors ETF up 15.4% for the month, that's fantastic. Then looking over 1 year, it's still very much driven by value. We've got the Divi Fund up 21%, and that's despite resources pulling back in June. Berkshire Hathaway Fund up 11.6% over 1 year, and healthcare in #4 position also looking quite defensive. So value and healthcare and China continuing to be the places that you want to hide during this volatile time. So let's look forward and see what we can try and work out what the markets are telling us. So equities are down more than 20%. And equities certainly are saying that we're going to see a recession. It might be a shallow recession, might be a deep recession. But other indicators are not agreeing. So just looking at fundamentals for a start, the World Bank, and yes, they are always behind the curve. The World Bank forecast growth for this year to be 4.1% in January. They downgraded that to 3.2% in April, and they've just recently in June downgraded that to 2.9%. That's still growing. That's not a recessionary level. In the chart here, the US leading economic indicator, this is probably one of the best indicators of recession. You can see on this chart how the indicator has dropped below zero every time that, and the gray bars represent the recession. Every time you can see a recession that has happened over the last 60 years, this indicator has dropped below the zero level. Currently, it's still sitting at 3%. It doesn't mean it won't drop going forward, but right now it's saying there's nothing to worry about. Similarly, the yield curve, which is pretty much the second best forecaster of recession, if the yield curve is inverted, it is suggesting a recession is on the way, but the yield curve, although close to flat, is still positive and not suggesting a recession. So the market, although equities are telling us that there's a recession, the rest of the indicators, market indicators and economic indicators are not suggesting a recession just yet. And I think there's good reasons for that. So what happened? Well, we had a terrible US CPI number come out. It was worse than expected. Not so much on the core side. Core actually continued to roll over as we predicted. So the core CPI in the US was lower than before, which was very good. But headline CPI, driven by fuel and food inflation, it was higher than expected. Actually, it reached a new high in the US, a new 40-year high. And as a result, the Fed panicked and surprised the market. So the Fed, for the first time since 2004, hiked interest rates by 75 basis points. Now, that was never the plan. The Fed was always happy to accept average inflation. Inflation could be higher than expected. They knew it was supply driven. They're prepared to just wait and look through what was happening. All of a sudden, we had one bad inflation print, and the Fed panicked, and they've since forecast. Not only did they raise rates by 75 basis points, but they're forecasting another 1.9% of hikes before the end of the year. And that was nearly 1% higher than they had been signaling before. So certainly that caught the market by surprise. And as a result, US equities were down nearly 10%. Chinese equities were up nearly 15%. And there was this rotation from west to east, which we have been expecting. And we remain underweight the US. Quite significantly, 16% on a global basis. But that said, I think the US can afford to hike what they did. The 75 basis points is not going to cause the economy to run into a recession just yet. And I think that inflation is still rolling over. So let's look at the indicators and see why. Well, as I said, core inflation still decelerating, which is positive. More importantly, core PCE, and that came out on the 30th of June. So that's our latest indicator from the US. Not only did it surprise to the downside, and it's the most important because that's the one the Fed follows in terms of their 2% average inflation target. Not only did it surprise to the downside, but month on month came in at 0.3%. So if you go back a month, we had a bad CPI number, which caused the Fed to panic. Now we're seeing the more important number, core PCE, surprising to the downside. So hopefully that means the Fed can panic a little bit less. Then looking just at what caused inflation to be so high, particularly on the core side, shelter and housing, that makes up a third of core CPI, and house prices are already coming off now that mortgage rates have increased by 2%. So while the Fed is behind the curve in terms of raising rates, the mortgage rates have already priced in all the hikes, and that is seeing a cooling of the US housing market, which will lead to a cooling of rental prices, and that'll bring down core CPI faster. At the same time, goods inflation is also coming off. and that'll continue to benefit as China reopens. If you look at the bottom right-hand chart in the green, that shows the ships that are backed up at ports off the US. And you can see there that the number of ships that are backed up has dropped from over 100 to below 20 and is close to pre-COVID levels. So that's very exciting in terms of supply disruptions coming to an end. And at the same time, new production comes online. The world finds a way. Capitalism is like that. When there's incentive to produce, people do produce. And the top right-hand chart shows that. So that's palm oil prices, which peaked with the invasion of Russia into Ukraine because of the disruptions to oil, particularly sunflower oil. And as a result, Indonesia and Malaysia have ramped up their exports. And you can see that those prices are now way below the levels pre the Russia-Ukraine invasion. So there are a lot of things that are positive for inflation. In particular, the US continues to shift as we expected it to. So the whole reason we had such high inflation in the US was because of the furloughs, the fact that people were paid to stay at home. They couldn't go on holiday. They couldn't go out to restaurants. They had this money to spend, and they spent it on goods. They bought new TVs, new cars, and at the same time, there just weren't enough TVs and cars because of the supply disruption. So we had massive demand, no supply, inflation went ballistic. We're starting to see that rotation come out. Now that lockdowns are over, people can go on holiday, they can go to restaurants, they can spend on services. So US spending for goods fell $43 billion, and spending on services increased to $76 billion. So we are seeing a nice rotation, which will take pressure off goods inflation as well, and move that spend to inflation, to services, which aren't seeing the same levels of inflation. So overall, we're confident that the inflation is likely to roll over. Yes, we always knew it was going to take longer than expected, but the peak is behind us. Now let's look at the US and what there's to worry about. Now the big fear and what's caused every other recession is unemployment. So inflation doesn't cause recessions. It's the Fed raising rates, which leads to companies firing people, and that unemployment rate rises, and that then leads to a recession. So that's what we've got to worry about. We've got to worry about number of people employed falling, and we don't see that happening for a number of reasons. So the Fed wants to increase labor slack. It's very important because the most sticky inflation is wage inflation. So they have to get labor slack to increase so that wage inflation doesn't spiral and then cause them to hike rates a lot more than they want to, which will then cause a recession. But fortunately, there are a number of ways that they can reduce wage inflation, or they can open up market slack. Firstly, they can increase labor force. And we think this is going to happen because the participation rate is still 1% below pre-COVID levels. Looking at it another way, number of people employed is still well below pre-COVID. So more people can enter the labor force. So that reduces or increases market slack. The other thing is that the firms can reduce job openings. They can basically do a hiring freeze without firing people, and that talks to that bottom right-hand chart. So then, which looks at the number of unemployed persons per job opening. So for every vacancy that's out there, there's only half a person that can fill that. That's the tightest it's been since this chart goes back over 20 years, and that's not a sustainable level. So we can very easily, firms can stop hiring, they can reduce the number of people they want to hire quite significantly before we even start to normalize that chart, before they even coming close to actually firing people. So we can see more people coming into the labor force, and we can see firms reduce the number of people they want to hire, both of which will improve market slack, and which will then help reduce wage inflation. The only way to improve market slack that hurts the economy is by cutting employment, and we can't see that happening. Again, firms have very, very strong balance sheets, so that they don't need to fight right now. The strongest balance sheets since the Great Financial Crisis. Likewise, consumers have very strong balance sheets. And this top right-hand chart there shows that US household savings are $2.2 trillion ahead of pre-COVID trend levels. So yes, things are looking tight around the world. That there's a lot of labor unrest. People are concerned about the higher fuel prices, food inflation, and that is impacting the wallets. But at the same time, the US consumers have got a lot of money in their banks that they've saved, partly as a result of the checks that were put into their accounts because of COVID, and just because of an increase in the wealth effect as well. So that means that they can afford to pay the high fuel prices before that they drastically reduce spending. And again, on household net worth, that's up 30% because of increase in house prices in the US. And while house prices might cool slightly because of increased mortgage rates, they're not going to collapse like they did in 2008. There's no big imbalance. In fact, we've got the lowest homeowner vacancy rate ever in the US. So yes, things are cool, but there's a lot of fat. There's a lot of fat in the homeowner vacancy rate. There's a lot of fat in US bank balances. There's a lot of fat in corporate bank balances. There's a lot of fat in terms of number of people unemployed or looking for jobs. So we think the system can handle the shock of 75 basis point rate hike that happened. And yes, there are risks. And if inflation continues to surprise the upside, well, then things could get worse. But based on the latest number, PCE number, hopefully the inflation is starting to cool. And looking at initial jobless claims, there's still not any warning flashing lights coming from the US. So although we remain underweight the US, we don't think that the economy is going to hit a brick wall anytime soon. So why are we underweight the US? Yeah, I'm spending all this time saying the US is not going to go into recession, or if it does, it'll be a very shallow recession. So here I also need to try and just pad what I'm saying. So the US has already had one quarter of negative GDP, and you only need 2 negative quarters to cause a recession. But the last quarter was very much based on inventory going from highs to lows, and so that inventory rebalance caused that first quarter of negative growth. So we might go into a technical recession in the US, but I believe that it'll be a shallow one if we do go into one. So why are we underweight the US? I think the biggest concern is that profit margins are at the highest level since 1960. Now, when you have profit margins at a 60-year high, that is certainly something to worry about. There will be some normalization between corporate profits and labor share. So basically, the share of profits is vastly skewed towards corporate earnings and not towards labor. And given that there is some wage inflation coming through, and we expect to see some wage inflation continue at the bottom end, there will be a rebalance away from corporates into wages. And while we don't think that's going to have a major impact on, or it'll have a minor impact on revenue. In fact, revenue should grow quite nicely because inflation, pricing, and pass-through will feed through to revenue. But profit margins are likely to shrink. So given the US profit margins are a 60-year high, we do think that there is some risk to earnings being downgraded in the US. Earnings still haven't been downgraded, so that's another risk. So we think profit margins are too high, and that we could see some disappointment, which could see some negative price action in the US. Not significant. I mean, the US is already down 23%, but I think there are certainly, while the economy might be resilient over the next 6 months, we could see some headwinds to earnings being downgraded. The other concern is that the dollar is at the highest level on a purchasing power parity basis since 1985. So as we expect to see growth shift away from the US into the rest of the world, that is going to see some dollar weakness. So right now, the dollar is benefiting from a flight to safety. As we start to roll away from the concerns that inflation has caused, we are expecting to see the dollar weaken. The other concern we have about the S&P is that it is a high duration index. By that we mean it's the highest rate growth stocks, or tech stocks, which are the most impacted by rising inflation. And Europe and Japan, in terms of developed markets, have more value and less tech in their indices. So they are a bit more sheltered. Yes, they've got their own issues. Certainly Europe has got big issues. I mean, I'm not talking about Europe or Russia this month. There's no dedicated slide to Europe or Russia because there really hasn't been much change there. It's the status quo in Russia and Ukraine. Yes, Russia's claimed a little bit more territory, that oil prices are down from their highs, from over $120 a barrel to close to $110 a barrel on downgraded growth. And certainly Europe faces a lot of risks, but there's also, at the same time, the media has moved off from this. And I think that the central banks, it was like COVID. In the beginning, COVID was very important to set the government, and was forced to do what social media was wanting it to do: lockdown. Lockdown was what people wanted. The people wanted to be protected. Then months later, people realized that lockdown was having a worse impact than COVID was having, and there was a shift in narrative. Right now, the rest of the world is starting to say, well, are the sanctions actually impacting Russia? I mean, Russia's still selling oil, but they're just selling oil via, let's say, via third parties into India and China. So Russia's still getting its oil. In fact, Russia's benefiting because oil prices have doubled. So if anything, Russia's net imports from net revenue from oil has doubled. So if anything, sanctions are helping Russia, not hurting Russia. Meanwhile, the rest of the world, and particularly Europe, is being hurt by sanctions. So maybe there's a better way of doing sanctions. And now that we've got past the shock, we might see clever ways of sanctions going forward, and less focus on oil. Yes, there are definitely still risks, and I'll talk about that positioning when I get to positioning. And there are risks that Russia could turn off natural gas to Europe, and that would be a big concern. But generally, it's not the status. It's pretty much a status quo in Russia and Europe. So the big impact is the US over the last month, and the Fed panicking and raising rates, and that is certainly what has caused the big sell-off in markets. The other big impact, and well, we will talk about it, is China, and that's one of the reasons why China did so well and was a great place to hide, up 15–16% for the month, was that China is continuing its rhetoric of supporting growth. So here we had Xi Jinping talking about or vowing to let 100 flowers bloom over the next 18 months. And this 100 flowers, each flower talks about deregulation. So there are going to be 100 measures of deregulation, which will make China more competitive in the global market, particularly in the tech sector, but across the economy. At the same time, President Xi said that China will strengthen macro policy adjustment and adopt more effective measures to strive to meet the social and economic development targets for 2022 and minimize the impacts of COVID-19. In a nutshell, they're saying China will make sure they meet their growth targets despite what happened through the zero tolerance COVID policy. And they look like that's already back on track. So growth is recovering very nicely as the impact of lockdowns diminishes. You can see the chart on the right there. Total social financing rebounded strongly in May and surprised the upside. Exports increased a whopping 17%. So China is back on track for growth. PMIs are above 50%, and it looks like growth is here to stay. And as a result, investors are starting to get comfort and move back into China. At the same time, they also had their second round of gaming approvals, which is very important for just sentiment in terms of the tech sector. And in general, you have to look at China and say China is deregulating. They're trying to become more market friendly. And in terms of protecting capital, there's a positive return on the risk-free rate in China. So China, despite being a communist, centrally driven society, they are protecting capital. You get a positive return in real terms on your capital in a risk-free rate. The US at the same time is increasing regulation, and there's a negative real return on your cash in the US. And you need to wonder, well, surely capital will flow from the one to the other. And we think that that's going to continue, that there will be a continued flow of cash from the West to the East as a result of the policies that we are seeing. Inflation also remains under control in China. It came in at 2.1%, again, surprising to the low side, which is very important. It allows continued government support. So while we've got the rest of the world with inflation surprising to the upside, being forced to hike rates more than they want to, on a knife edge as to whether they push their economies into recession, China is nicely coming out of COVID dip And in fact, it's unlikely we are going to even see a recession as a result of the COVID lockdowns. Growth is recovering, interest rates are being cut, and deregulation is helping the economy recover. So all is looking rosy in China, and we're very comfortable keeping our overweight to that region. Emerging markets in general, but more of a mixed bag. Yes, there are certainly headwinds. One of the side effects of a strong dollar, certainly not something that the Fed cares about or worries about or tries to achieve, but strong dollar is what happens when the US raises interest rates, is that it becomes a headwind to emerging markets, primarily because emerging markets do 80% of their external funding in dollars, particularly when it comes to funding commodity prices. So yes, that does hurt, but EMs are definitely better positioned than they were in the past. They've got current account surpluses compared to current account deficits. There's a strong Chinese underpin, and China makes up about 40% of emerging market indices. And there's now the new support from petrodollars. So the one benefit, well, the other region that's benefiting from higher oil prices besides Russia is the Middle East. And the Middle East likes to recycle those petrol surpluses into emerging markets, particularly emerging market FX. So we are seeing some, or likely to see some flows there, and that's great because flows into emerging market FX keeps the currencies stronger than otherwise would be, which keeps inflation lower than otherwise would be, which means that emerging markets don't need to push up interest rates as much as required, which means growth doesn't get stifled as much, and equities can do better. So generally, we are still neutral to bullish on emerging markets as a result of those three support factors. Okay, we have to take a bit of a break before we move on to South Africa. A deep breath. Here we've got Chief Justice Raymond Zondo, who's been in the headlines with chapters 5 and 6 coming out. I was certainly waiting for episodes 7 and 8, or 8 and 9 of Stranger Things 4 over the month of beginning of July, and we were also waiting for the final chapters of the Zondo Commission. I don't know which one was more of a harrowing watch or read, so I've actually left it to Zapiro to say better than I can say. The Zondo report, and then you can see what do we do now? What we always do, carry on as normal, and that seems to be not only the response to the Zondo report, but load shedding. Load shedding has been going on for 14 years now. We've hit stage 6 for the first time since 2019. Things are not getting better. Things are getting worse. It's just carry on as normal, and nothing seems to improve. Now, it's quite a shocking state of affairs. I mean, the Ukraine is under invasion from Russia. They're being constantly shelled every day, and yet the trains and electricity is on. It's still working. South Africa, we're not in a war, and yet we're in stage 6. And trust me, we talked to a number of companies, listed and unlisted, mostly who are our clients, to get a feel for what's happening out there in South Africa. And if we're in stage 6, the big industrial producers and the mines are not doing anything. We're not manufacturing anything. We're not getting anything out the ground, which means that profits are not being made, revenue is not being produced, and jobs are not being created. And worse, even if we were, Transnet is not operational because they don't have any trains that work, because they're waiting for parts from China, because they bought Chinese trains. So we've got no trains, we've got no power, we're getting nothing to the ports, and nothing's being exported. So certainly it's going to be some bad news coming in terms of trade and the growth over the next 6 months. And it's not just Eskom and Transnet, but the strike that we've had, and half of the load shedding has been blamed on the unlawful strike. Well, it's an unlawful strike. We haven't had any police protection to protect the poor workers who are getting stoned and firebombed. The Eskom workers are trying to get to work. There's no protection, so there's a failure of the police. And I'll talk about it on the next slide. That same failure reflects in our tourism numbers. Not only that, but the green drop survey shows that more than half of South Africa's sewage treatment plants are failing in a state of disaster. Basically, South Africa is just one big state of disaster without a state of disaster to protect it being a state of disaster. And it's just really I'm speechless. It feels like the ANC wants to lose their majority. That's what it feels like, because what do? Well, we do what we always do: carry on as normal. And you can't. You need to fix things. You need reforms. But we're not seeing anything happening. So, chart on the right there, just there to remind us that the main reason the rand is weak is not because of load shedding, and it's not because Transnet has no trains, and it's not because there's no sewage, and it's not because there's no tourism, and it's not because there's no reforms. The main reason that the rand is weak is because the terms of trade have deteriorated. So the orange line there shows the terms of trade. It's an inverted number, so it weakens as it goes up. And basically what that means is terms of trade is what's your exports, and we export metals, iron ore, platinum, gold, palladium, and we import oil. And so when that ratio deteriorates, well, our currency weakens. So in lockdown, we had phenomenal terms of trade. There was no load shedding. We could export metals. Metal prices were at great highs because of supply disruptions. Oil was at an all-time low because no one was using it, and so our terms of trade drove the rand strong. Now we've had the reverse. Oil prices are at new highs because of the supply disruptions, and metal prices have fallen nearly 14% over the month of June alone because of recession fears. And as a result, the rand has weakened. So we do think the rand will continue to face some headwinds just because of our terms of trade. Yes, metal prices should recover because ESG and the move away from oil as oil and natural gas and into renewables is copper heavy. So we do think metals will recover. It might take a few months. The rand will cover, but right now, in the short term, we think we see a bit more rand weakness on the way. So we remain underweight South African equities. We think that is a safe position. We do remain overweight South African bonds, and yes, that's hurt a bit. But when you've got negative real yields in the US, minus 5% real yields in the US, and you've got plus 6% real yields in South Africa, that's a 10% different spread. I'm much happier earning a 10% real spread in South Africa. Yes, there might be some more volatility in the short term, but I don't think that will continue. We certainly remain bullish on bonds, and we think that there's enough of a buffer priced in to be prepared to accept a bit more volatility. So let's look at our positioning. Markets will remain volatile. Yes, that's something that we acknowledge. We think that we are in a volatile decade. We've got a lot of debt. We've got low growth, and when you've got low growth and high debt, markets and economies stay volatile, and any supply disruption or any panic of the Fed does cause exaggerated moves. And we're positioned for volatility. We'd like to harness volatility. So it's simply something that our balance funds we are making use of. And yes, risks remain high. Turkey has now dropped its opposition to Finland and Sweden joining NATO, which may cause Russia to further curtail gas supply. So right now, natural gas supplies into Europe have been reduced. Russia says it's technical issues and that it's not politically driven, but that is putting a bit more pressure on Europe and Germany in particular. Germany is likely to pass on that pressure to the rest of Europe, but certainly Europe is experiencing massive energy squeeze and high energy prices, which is not great for consumption. And Europe is very likely to see a recession, definitely a shallow recession, and if gas is curtailed even further, a deep recession. Now, one of the reasons they are seeing a recession is because they've had 6 stages of sanctions, and they're trying to wean themselves very quickly off oil. but at the same time, I think that they're starting to realize that maybe they've pushed things a bit hard. And they've already, despite, they're backtracking on some of their ESG targets, and they're already now allowing the approval of new natural gas plants. So that was that, there was supposed to be no new natural gas, no coal, no oil, and that European economy was supposed to be weaning itself off that and moving into renewables. Not only are they allowing existing plants to increase production, but they're allowing new facilities to be produced for natural gas. So, yes, those don't happen overnight, but what it shows is that governments are being a little bit less pedantic about how they review this and trying to protect growth more than inflation or in part sanctions. So we believe that central banks will choose inflation over recessions. And central banks, yes, they have to worry about credibility, but they also want to make sure that people don't lose their jobs and that unemployment doesn't tick up too significantly. Yes, the unemployment rate can go up as a percentage. Yes, market slack can go up, but the number of people employed mustn't fall. So, and I think that they are going to be watching that very closely, and their rhetoric will turn dovish if the number of people employed starts to turn anytime soon. That said, we remain overweight our defensive sectors of value, health, and China, and we continue to anticipate further rotation away from the US to Asia. China in particular, where government support and the post-COVID dividend is most attractive. But EU in general, they're working flat out in terms of semiconductor production. The top 3 countries in EM index, which make up 85% of the EM index, are the biggest semiconductor manufacturers in the world, and they certainly are working flat out to help get that supply backlog under pressure. So the question is, what do you do with your cash? Where do you hide? Well, the first port of call is normally gold, and what I want to point out here is that yes, gold is a great place to hide, but based on a purchasing power parity basis, gold is trading at double its valuation. So if you're holding gold as an inflation hedge, it's not an attractive inflation hedge. It's still skewed by the risk-off scenario, still skewed by quantitative easing, and so as an inflation hedge, it's worth double what it's supposed to be worth. So yes, it works well in terms of a safe haven, but if you're holding it for inflation, so if you expect things to get worse in World War III to arrive, well, yes, buy gold. But if you're buying gold for an inflation hedge, it needs to halve before it actually becomes an effective inflation hedge. So gold, I would continue to avoid. The other is dollar cash. Dollar cash certainly was our preferred basis. We like dollar cash instead of global bonds, because global bonds are also distorted by quantitative easing. But your chart on the bottom right there shows that US dollars, the most expensive they've been since 1985. Not only are they expensive, but the chart on the right shows that over the last 20 years, the central banks of the world have been diversifying their FX reserves away from the dollar. So the green line is other currencies ticking up. The brown line is the gold ticking up. This is holdings of central banks, and the black line is the dollar, which has fallen from above 70% to below 60% in terms of percentage of FX holdings. And we think that will continue, particularly the sanctions that were put on, dollar sanctions that happened to Russia will keep the Middle East and other emerging markets not investing in the dollar. So generally, I think the dollar is looking expensive, and we prefer other cash, other developed market currencies. We have our favorites, but besides non-dollar cash, well, then that leaves equities, and we like our defensive sectors, as I've mentioned, value, health, and China are already a good place to be, and that we continue to avoid those sectors despite the risks that exist. So it is tough out there. Volatility is going to stay high, but we're sticking to our positioning, and we are watching every short-term indicator that comes out, everything the Fed that watches, we're watching, and we're ready to act, and we continue to act, and as we have been, to harness the volatility that's being produced. So overall, just looking at our positioning in general, and we all know this slide, small overweight to global real estate, and that's our proxy for not bonds. We don't have any bonds. Small overweight to disruptive technology. That's only fourth industrial revolution. That's because it's the cheapest it's been since it listed. It's now trading at a discount to the S&P. It's a proxy for US small cap, which again is also at record lows. But it's only a small overweight, and we haven't been topping it up because we're waiting for a clear signal of inflation having peaked in the US. And then that leaves our three preferred sectors: emerging Asia, big overweight. It's our biggest overweight, and the biggest overweight within that is China. We've got the China new sector ETF. We've got the China new economy unit trust, and we've got the emerging market 50 ETF. All three of those we're holding as overweights. Health innovation, we continue to hold as a defensive sector. That's something you hold throughout the cycles. It's not something you need to sell. There are strategic reasons why we hold both. Emerging Asia, the strategic reason is that there's the emerging middle class. The next billion emerging middle market is going to come from emerging Asia. Health innovations, we expect the aging populations to drive that. And so it's not, so that's the long-term reason. Short-term reason is defensive. There's a lot of purchasing power in terms of healthcare, so margins aren't squeezed as much as other sectors in rising inflation environments. So here we hold Sygnia OSI fund, and I need to remind everybody that there's a newsletter coming out in the next few days. Nice 14-page newsletter which you can read about, and some exciting prospects in the Oxford Sciences Enterprises fund. There is currently some capacity that's available. So have a look, look out for that newsletter. And if you're comfortable, then try and grab some of that capacity before it disappears. So we are overweight Oxford Sciences Enterprises. We also overweight the Health Innovation Unit Trust, which has genomics exposure. Any of you who watched my investment forum presentation, I spoke at length about genomics. That's actually proven to be quite defensive over the last 2 months, and we're very excited about what's happening there. It's about 30% of that sector is trading below cash levels, so very, very exciting and quite defensive. And then we also hold the Sole Active 160 healthcare ETF. So exposed overweights in all three of those. And then value. We continue to like the UK. We continue to hold US value and global value, all of which should do quite well over a rising interest rate environment. Remain underweight South African equities, overweight South African bonds, overweight global equity, and underweight global bonds. No changes to those views. There've been a number of short-term swings that we do to harness volatility intra-month, but nothing that changes our medium-term view. Okay, so that is that. Let's see if we can answer any questions. So a question from Andre: will Sygnia consider launching a Sygnia Itrix MSCI All Country World Index? So Andre, as I'm sure you know, we do hold the Sygnia Itrix MSCI World Index, and the All Country. The only difference is that it holds some emerging markets. So we aren't looking to do that because we do have instead of launching that, we were thinking about launching that. Instead of launching that, we launched the S&P Global 1200 ESG Index. So that's the equivalent of the MSCI All Country World. It also has an emerging market exposure, but it's got the benefit of ESG. So if you're looking to invest in an MSCI All Country World Index, I would suggest having a look at our S&P 1200 Global ESG ETF. That is, it is developed world and emerging world, and it's got the benefit of the ESG overlay, and it's at a great price. I think it's the cheapest ESG or all world index that you can get out there. So please have a look at that. Paul asked for the slides. Paul, yes, please. We do make the slide. The presentation is available on our YouTube website if you want to listen to the presentation. And in case you want to hear any of my nuggets of gold. But if you just want the slides and you don't want my lovely voice, then please email and we will send the PDF to you. Okay, Darren asks, is there generally a uniform, predictable time after yields drop to zero that a recession begins? Always been different every time, and Darren, has been different every time. So that lead indicator, each recession has been different, and it hasn't predicted whether it was a shallow or deep recession at this point in time. As it falls, we can make inferences, but right now all we know is that it's positive, so it's not suggesting that there's going to be a recession just yet. And as does the yield curve. Andre asked about the mismatch. Yes, Andre, when I talk about, I do put up some indices which are different to the benchmarks that we track in various funds. So there's not going to be the one for one. So as you would have seen in the market sheet, China was only up 14%. Whereas our China unit trust was up 16% and our China ETF was up 15%. So there are going to be slight differences between the fund performances and that market performance, just because there are slightly different benchmarks or indices that are used. And not all of our funds track the exact index that we use. So for example, the All Share Index is one that's used in South Africa for equities, but we prefer the Swiss index for our funds. China, we've got the new sector, new economy indices, but we benchmark against the Shanghai Composite. So there are nuances that are there. On the global side, we've got both MSCI World and S&P 1200 Global ESG. So there will always be slight differences depending on which fund you prefer, which index you prefer. Mervyn asks, he says, you're underweight the US. When do you envisage being neutral to overweight the US? I think we are waiting for confirmation that inflation has rolled over, and then we're likely to go neutral US. But and although there are indicators that we're getting close to that point, that not there. There's still a risk that the Fed could disappoint to the downside, which would lead to further downside. And that's why we stay underweight that market. Andre asks when we think markets are likely to recover. I certainly think that over an 18-month period, markets should be higher. It might be sooner than that. It all depends on what happens to inflation and what risks escalate in Russia, and what that does to oil price. So if we've seen the lows, the highs of oil, and if the worst has happened, then markets could rally quite soon. But if there are continued inflation hikes as a result of oil being disrupted, then that could lead to a delay in recovery. Chris asks, while rating agencies in South Africa have such a positive view on South Africa, Chris, they all still rate South Africa as junk, so I wouldn't say that's too positive. But yes, that they have, a lot of them have upgraded their outlook to neutral or even positive, and that's mostly because of the very strong terms of trade that we had over the last 2 years, which led to revenues, surpluses, and overruns relative to expenses. Now that those terms of trade have switched, we could see them downgrading their view. I do think that metal prices will recover in the next 6 months, so hopefully we don't get to that point. But yes, that's the positive. There is not driven by growth, but just on our ability to not take on more debt, and that just looks at whether there's going to be a revenue shortfall relative to expenses, and as long as resources are giving us windfalls in terms of taxes, or the rating agencies can afford to be positive on a junk view. Mervyn asks when the good times for the Divi fund are going to end. Well, we continue to be overweight value. We think that values continue to do well. So yes, volatility will happen. The Divi is quite a concentrated fund, and I'm not saying there is not going to be volatility, but we continue to be overweight value, and so we continue to be overweight Divi locally and on our value funds globally. Yes, Superior says, am I not going overboard with my negativity towards South Africa, claiming that everything is a disaster? That is true. Yes, everything is rather top of mind, but my view has been that growth in South Africa can't happen until there is stable power, so that people can feel confident about investing. You need stable power to build manufacturing plants. You need stable power to build mines. Now, there was this illusion that that raising of the unlicensed power creation, so self-creation of power up to 100 megawatts, was going to change everything, but it didn't. Firstly, 100 megawatts is tiny, and secondly, while the license is being removed, you still need NERSA to approve every facility that you want to bring online, and you still need the Minister of Energy, Grady Mantashe, to approve every project, and those aren't happening. So I remain underweight South Africa until I see South Africa being allowed to fix things itself. So let me look at it the other way. Are we concerned that SAA is bankrupt? No, because we fly SAFair. Are we concerned that the post office is bankrupt? No, because we use Postnet. Are we concerned that SABC is bankrupt? No, because we use ETV. But unfortunately, while the government doesn't allow alternatives to Transnet and Eskom, we're never going to have, we're never going to be able to export, and we're never going to be able to get investment into the big employment sectors. We can't create jobs without building new mines and new facilities. And we can't do that because we're not allowed to, the private sector is not allowed to create energy or build its own railway lines. Yes, to some extent you can use trucks, and that's one of the reasons that our roads are in such a horrendous state, because we've got way too much on trucks. It also is why our food is so expensive, is because everything has to be trucked and nothing can use rail. And again, it's terrible for the environment. It's far more worse for pollution to use trucks over rail. So I suppose to some extent we can use alternatives to rail. And I suppose to some extent, everyone's got generators or batteries, but in general, until the government allows South Africa to fix the solution, and we're not even asking government to fix the solution, because that's not something that, it may happen, I'm not saying it's not going to happen, but we don't even need the government to fix the solution. We need the government to allow South Africa to fix the solution, and that's not being done. So I remain negative until we're allowed to try and fix the solution. And then I'm sure we will. South Africans are very, 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 very innovative, strong entrepreneurs, and I think we can get back on track. And at that point, yes, then we're probably going to go overweight the rand and overweight South Africa. But right now, we're not allowed to. Chris asks, Larry Summers has reworked US inflation, which shows that current US inflation is remarkably similar to what happened in 1980. However, there seems no change that Powell will do a Paul Volcker and push interest rates sufficiently high to crush inflation. Given that scenario, isn't it likely that we're going to have to live with inflation, a higher inflation than we would like, at least over the short to medium term? Chris, I think that you've hit the nail on the head. The question is, will central banks, and it's not just the US, will central banks, do they have the stomach to do what Paul Volcker did and push the economies into a deep recession to try and get interest rates under control? So there are a lot of differences. Firstly, yes, the early 1980s, late 1970s was supply side driven. It was the oil supply, but it was preceded by a decade of very strong demand driven inflation, because growth was incredibly strong up to that point. This is different. We haven't had very strong demand over the last decade. In fact, we've had since the great financial crisis, we've had the weakest growth recovery ever. So we haven't got that same demand push to inflation. There's some, but I think the central banks realize it's mostly supply-driven inflation, not demand-driven inflation. So they're going to look at that differently. They're going to say, pushing interest rates is great if there's demand-driven inflation that you have to control. But its majority of currently is supply-driven inflation. So I don't think Powell's, he realizes that he can't fix what needs to be fixed, as unlike Paul Volcker, who realized it was demand-driven inflation that he could fix. At the same time, Powell's looking at inflation and saying, well, we're targeting average inflation, and we have been under the target, so he can afford to take on a bit more inflation than in the past. So that the whole reaction function is different. But I think most importantly, this applies to all central bankers. They're more worried about destroying jobs than they are about inflation. So I think what that means that inflation is going to, you're spot on, and they are going to allow inflation to be higher for longer. They're going to certainly try and squash it as they are, but they're not going to push rates to the point where inflation becomes deflationary. They're just going to hope for a slow runoff of inflation. So that means high interest rates for longer, higher inflation for longer, which means you don't want to own global bonds, but equities tend to do quite well in those environments. And that's why we remain overweight equities, underweight bonds, and that we think that rather than go for a hard Paul Volcker, destroy the economy to get inflation under control, this time they're going to allow inflation to roll over and take longer to get into the band. And there's a lot of risks to that scenario. It's our base case scenario. There's a lot of risks, particularly around Russia. But assuming none of those risks materialize, I think that's what we're going to see. Kubis asks, are we exposed to infrastructure projects as a hedge against inflation? And you're right, infrastructure projects are a great hedge against inflation, as are inflation-linked bonds. So we do have some inflation-linked bonds in the skeleton balanced funds, and that is working well. And we are focusing very hard to try and get exposure to infrastructure products. We've been, for the last 2 years, we've been looking into infrastructure projects. We've been working very closely with a number of suppliers for the renewable energy project round 5. But as with everything, when it comes to things that are linked to the government, there have been delays and delays and delays, delays and delays. And so not only was the emergency power round that never came to fruition, a small part of it might, but round 5 is also not. So we've got money waiting to be deployed, and I'm sure everyone's very keen to get round 5 up and running, but we haven't even deployed the money to start those projects yet. It's still in the feasibility stage, and that's been delayed at least a year. So again, talks to my negative reaction function on South Africa, that things are just taking longer. People aren't allowed to do what they need to do. There are delays to fixing what needs to be fixed. Right now, we don't have those infrastructure projects available. Sean asks, countries around the world have been stockpiling gold above normal levels. And that's what my chart showed, Sean, you're spot on. Governments have been diversifying away from the dollar and into other currencies, developed market currencies and emerging market currencies and gold. So to the extent that those, South Africa has all its FX reserves in gold. And I think that they just use a diversification approach. So central banks around the world see gold as another currency, and they buy a basket of currencies, including gold, and use that to diversify their portfolio. Mervyn asks if we're overweight global property. Yes, Mervyn, it's hard for me to give you an exact number because it differs per fund. So, depending on which funds have how much global equity, they'll all have different weights into different weights into global property. If you send an email, we'll give you the exact breakdown of those funds. Louise asked about the SA yield curve, with the 2-year point, is this going up or going down? Louise, I agree with you. I think that the 2-year point has been overstated. So the 2-year point is suggesting that interest rates in South Africa are going to reach 8%, which I think is unlikely given where our growth levels are. So I think that generally the whole yield curve is a bit too high, pricing in a bit too much inflation. And that's why we're quite comfortably overweight the overweight bonds across the yield curve. I mean, at the 10-year space, you're getting 11% yield. I think that's too high. At the 2-year space, you're getting what, 3% real yield. I think that's also too high. So I think in general, the SA yield curve is pricing in too much risk or too much inflation. But South African bonds have never been a safe haven investment. They've always been something that is a risk-on investment. So it's currently working exactly as expected to work. In a risk-off environment, the rand weakens, and South African bonds weaken, but value is there. Yes, so for South African bonds, we are holding this by the Sygnia bond fund, and depending on the funds, we also have some active management exposure and our preferred active managers. So depending on which fund you have, the signature range and the CPI range have got exposure not only to the Sygnia index bond fund, but also to active bonds through our two preferred active managers. Simon asks, should I continue to invest monthly in the fourth industrial revolution ETF? So Simon, I continue we continue to hold that position. It's the best that I can say. And so when we have flows, we keep topping that up to keep it in line with our models. We aren't allowing it to get any smaller. We also aren't topping it up. We think there's a lot of risk and volatility, but over a medium to long term, still very excited about fourth industrial revolution. I spoke about it at the investment forum. We think that innovation funds are here to stay. Yes, they've been hurt. They've been hurt because COVID moved from a pandemic to an endemic. They've been hurt because interest rates started to rise, which increased the cost of capital in the US, and that caused all growth funds to come off. But the reason that innovation funds exist is that there's a dearth of growth opportunities in the world, and we think that's going to continue. That's why we like our thematic investing. We look for areas to invest that will show growth in a low growth world. And we think the low growth world is going to invest for the next decade. In fact, the low growth world is getting worse as a result of what's happening in Europe. So as growth falls further, you want to find areas that can still grow in a low growth world. So that's why we like healthcare. Not only is it defensive in terms of its margins and inflation environment, but there's aging populations, which means it will continue to grow not only the number of people that it serves, but the various products that it serves as innovation escalates in health innovation. Similarly, we like emerging Asia because China and Asia continue to see increases in living standards. So there'll be people buying more TVs in Asia, even as growth slows. And innovation stocks, or as we prefer to call it, disruptive technology, and that's fourth industrial revolution. And we are about to launch a brand new ETF, the Sygnia Itrix, what is it called? Sustainable Economy ETF. Was basically more of an industrial version of the fourth industrial revolution. We're very excited about that in particular, but also fourth industrial revolution. So that focuses on the parts of fourth industrial revolution that we're very excited about right now. But we are excited about fourth industrial revolution as a whole, because it has a broad, diversified exposure to growth and innovation stocks, and those companies will continue to grow market share over the next decade. So what we really like in that sector, we've got 4 carve-outs which we put into the sustainable economies. Renewable energy, we think that's going to have a massive burst going forward. And it's not only wind farms and solar panels, but it's also hydrogen power. The entire hydrogen infrastructure network is going to do very nicely. But the sustainable agriculture is going to take off as a result of food shortages and the move to green and water shortages. Sustainable manufacturing, that's going to happen as there's higher wage inflation. There's going to be an increased demand for robotics, so we overweight robotics. And sustainable society, and that's moving the metaverse and the move to an online world that was helped by COVID. Yes, there's been a bit of a decrease as the economies open up, but that's going to increase now with higher fuel prices and people trying to, again, work from home because of the cost of transport. So there are a lot of very, very exciting reasons why we like the fourth industrial revolution. Fundamentally, yes, macro, top down, there's some volatility when it comes to rising interest rates, but we're very, very excited about the prospects of that fund, as we are of all our thematic growth sectors. We like those sectors. We think they're going to do well over the next decade, despite low growth. And that's why we remain overweight equities, because those sectors should continue to be defensive and work well now. And yes, while in the short term there's more volatility in 4th IR, very excited about the prospects of that fund. 600 stocks, 26 thematic indices within 4th IR. We like it. We certainly are going to go overweight the new fund when we launch it. We're probably about a month away. We're still waiting for JSE approval, but and there will be a webinar on that specifically, which I spoke about at the investment forum, but talking about the industrial focus of the fourth industrial revolution in those sectors, which will do particularly well in the current environment of energy shortages and food shortages. So here we're looking at what works well in the current state of disaster and what benefits, and that's what that fund is focused on. There's also, I spoke about, and I can do an entire webinar on, it's very exciting, and it's a big reason why we're optimistic on an overweight Sygnia Oxford Sciences Enterprises Fund. It's got a decent holding in First Light Fusion. First Light Fusion is making dramatic headwinds in fusion. The joke about fusion has been around since the 1970s. The joke has always been that fusion is 30 years away and it always will be. That has now changed. There's been a dramatic shift in the way that fusion has been done. Fusion has always been done using inertial fusion, and now we're looking at projectile fusion. And not only is it a change in the way it's been done, but the UK Atomic Energy Authority has actually approved that First Light Fusion has been successful in its test facilities, and we're very excited about that. I mean, we've been to the facilities; they look phenomenal. They're very exciting, and we're very excited about fusion. So a lot of things to be excited about going forward, and you just need to look at what the current states of disaster in the world are driving and what that will impact going forward, and you invest accordingly. And that's what we've done, and that's why we like health innovation. That's why we like Sygnia Oxford Sciences Enterprises Fund. What a mouthful! And why we like, in particular, sustainable economy ETF, but that's very much linked to fourth industrial revolution. So Mike, Simon, long answer to my story, but yeah, we continue to be very bullish on the fourth industrial revolution in the medium term. Mike asked what's happening to the dollar. So Mike, the dollar is the most momentum-driven instrument in the thousands of instruments that exist. So in the short term, the dollar is likely to stay strong, but it's very, 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 very expensive. So again, when we start to see things change, when we see a peak inflation, we think that it could weaken quite fast and quite far. Charles asks about a prediction from Michael, who is talking about the end of the world, and all I can answer to that is that the end of the world is definitely a risk. I'm not saying it's not a risk, but right now everyone is nervous. Everyone is calling the end of the world. There are a lot of doomsayers out there, and bad news is much easier to sell than good news. So the media likes it as well. People like to be dramatic, and it's very easy to be dramatic about bad news. So we like to focus on what Warren Buffett says. When there's fear, when it's time to buy, there's a lot of fear out there, and that is certainly a good indicator. But I'm not saying that we're through the woods. What I'm saying is that the markets are priced in a shallow recession, so it is priced in quite a lot. If there's a deep recession, yes, markets could fall a lot further, another 10%. But if we're only going to see a shallow recession, well, then markets could bounce. and we think the odds of a shallow recession are higher than the odds of a deep recession. So what is it? Well, it's probably a 60% chances of a shallow recession, which means markets will bounce a little bit. There's probably 30% chance of no recession, in which case markets will bounce a lot. And if there's probably a 10% chance of deep recession, in which case markets will fall 10 to 15%. So you take your weighted average to that, and we do think markets have more upside than downside, and that's why we are slightly overweight. But there's no shortage of doomsayers right now, and they could be right. And that's the nice thing about being a doomsayer, is that eventually you will be right, because recessions happen like clockwork every 8 to 10 years, and you can, as long as you call it, you can tell everyone that you called it. Of course, the fact that you're out of the market over the preceding 10 years means that you're way behind. So it's calling a recession and investing according to the recession, two different things. John asks when we think S&P 500 and Euro Stock 50 will start regaining the losses of 2022. John, it all depends on the inflation prints that come out and whether things worsen in Europe. Sean asks about US bonds. US bonds are certainly not predicting a recession. Yes, they have come off a bit, which is great, but they're not predicting a recession yet. There could be some downside to US bond yields if a deep recession happens anyway. Monica asks if we're hedging equity exposure in Skeleton 70. Yes, Monica, we do have a small hedge. We are overweight global equities with a small hedge on our global equity position. It's always good to have some protection, and we do like to take advantage of volatility. Sean asks if ESG hype is going to create a bubble. Sean, I think that things like Tesla were already in a bubble driven partly by ESG, and so I think there are sectors that ESG and some metals had a bit of an ESG hype, but I think a lot of that hype has come out, and so I think things are looking more normalized in those sectors. Fonsa asks where we are on UK equities. Still overweight UK equities that have done phenomenally well relative to the rest of the world over the year to date, but and because they have good exposure to energy and oil in particular, we think that it's a good place to carry on being positioned to make change. But right now, we think that it's good to have those hedges against higher inflation and higher oil. Thank you for all the thank yous. Antonio asked about guaranteed annuity rates. Yes, guaranteed annuity rates do rise when bond yields rise, which is quite a nice hedge. And again, it's why you don't necessarily have to be in cash when you retire, because being in a low equity balance portfolio has a large exposure to SA bonds, and SA bonds, as they weaken, yields go up, and then you can also, it's the weakening in those values is backed against cheaper annuity rates. So annuity rates will continue to stay cheap as long as bond yields continue to stay weak. Sean asked, I think Sean, you hit the nail on the head here. 6% unemployment rate was deemed full employment in the US. Why is the Fed so worried about unemployment levels rising now? And I think that's what I'm talking to. So the Fed wants to increase slack to avoid wage price spirals, but they can actually afford the unemployment rate to go up. Not the number of people unemployed. So they want the employed people to go up, but the unemployment rate can go up at the same time. So it's all looking at the different ratios and what causes those ratios to work. Clement asks if retail bonds are a good investment opportunity. We are overweight South African bonds, so yeah, I think it's a good opportunity. All depends on your time frame. Altus asks what funds give maximum exposure to thematic funds. All our funds have exposure to thematic funds. Our global only funds, so that'll be the Skeleton International Equity Fund of Funds. Because it's a global only fund, it has higher exposure to thematic funds. Obviously, it's hard to find, well, it's nearly impossible to get thematic exposure in South Africa. Got a bit of value through the divvy, but you can't get healthcare exposure, and you can't get China exposure, and you can't get disruptive technology exposure. So the more global a fund has, the more thematic fund exposure it has. So the more equity the fund has, the more thematic it has. So our 100% global equity fund, Sygnia Skeleton International Equity Fund of Funds, has the most thematic. Then Skeleton Balance 70 has the next amount of thematic, etc. Last question from Sean. He says, on a 3 to 5 year view, would you be overweight Europe and what region? Sean, we're not particularly excited about Europe. It's cheap, but it's got a lot of issues. The biggest issue for Europe, excuse me, is that Europe is a monetary union, but it's not a fiscal union. So the US is a monetary and fiscal union, which basically means that if Florida is doing badly, Texas money from Texas can be used to build infrastructure in Florida to try and support employment in Florida. Europe is different. It's got a single monetary mechanism, but it hasn't got any fiscal transfer. So if you need to build roads in Greece to support employment there, you can't without Germany's permission. So Europe as a whole, it's cheap. It's got a big issues right now in terms of energy. But as a whole, we're not that excited about Europe because of the structural issues that happen there. So, when it comes to long-term overweights, we like our thematic views. So we don't have a particular regional view. We refer to overweight healthcare within Europe, for example, or technology shares within Europe, and not Europe per se. Right now, because we have a value tilt, we've got some banking exposure to Europe, but it's not, we're not particularly excited about Europe. And that's it for today. I hope that this was useful, and good luck for the month of July. Let's see where it takes us, and let's watch those economic indicators very closely. And hopefully we have some better news when it comes to August. But don't invest for hope. Stay defensively positioned and harness the volatility. And all the best. Cheers.